Hey, welcome to The Explainer. Have you ever wondered how a brand new company gets the cash it needs to really get off the ground? Well, a lot of the time it's by selling off tiny pieces of itself, which we all know as shares. Today, we're going to break down the accounting behind a really key part of that process, issuing those shares at par.
It really all comes down to this one simple but super important question. You've got a company with a brilliant idea, but it needs money, capital, to hire people, build things, and grow. One of the most common ways to get that cash infusion is to sell ownership stakes, those shares. But how does that actually look on the books? Let's find out.
So, we're going to follow the money step by step. First, we'll cover the basics of what at par even means. Then, we'll walk through the three main stages of this process: the application, the allotment, and what are known as the calls. And finally, we'll wrap it all up to see the full financial picture.
All right, let's start with the absolute fundamentals. Before we get into any of the debits or credits, we need to get a really clear idea of what we mean when we say a share is issued at par.
You know, it's a surprisingly straightforward idea. Just imagine every single share has a price tag printed on it. That's what we call its face value, or par value. So when a company issues shares at par, it's just selling them for that exact price on the tag. If the face value is, say, $10, the investor pays $10. It's really as simple as that.
The whole process of getting these shares out there and collecting the cash for them follows a pretty logical sequence. It usually happens in these three main steps. Think of it like a journey, starting with an investor just showing interest and ending with the company having all the money in the bank.
And that journey kicks off right here with the application stage. This is where the public gets their first chance to throw their hat in the ring.
So the whole thing starts with the application. A company can't just sell shares to whoever. It first has to see who's actually interested. So people who want to invest fill out a form and send in a deposit. This first payment shows they're serious, and in the world of accounting, we call this application money.
And here's our first peek at the journal entries. Now, in accounting, a debit usually means money is flowing to an account. So, the bank account gets debited because, well, cash is flowing in. The credit tells us where that value came from. In this case, it's a temporary holding spot called the share application account, which is just keeping track of all these deposits.
So let's put that in plain English. The company's bank account is bigger, which is awesome. But, and this is a big but, it doesn't totally own that cash yet. It has an obligation. It either has to give those applicants shares or it has to give them their money back.
Okay, so the company has all this application money sitting there. Now it's got to make a decision. And that brings us to step 2. The allotment.
Allotment is basically the official act of saying, congratulations, you get the shares. The company's board of directors will decide who gets what, and this is the magic moment. It's when that initial deposit, the application money, officially transforms into the company's permanent share capital.
And the accounting makes it official. The share allotment account is debited, which shows this money is now due from the new shareholders. But here's the really important part. The share capital account gets credited. This isn't a temporary account anymore. This is the permanent record of ownership. This entry is what legally creates that new slice of the company pie.
Next up, the company actually needs to receive the money for this stage. So when the shareholders pay, the company's bank account gets another debit, another boost to its cash. Then, the share allotment account is credited, which basically cancels out the IOU we just created. It's marked as paid.
Now, here's a fun scenario. What if the share issue is a massive hit? I mean, it's a great problem for a company to have, but what if it gets way more application money than it has shares to sell? This is a situation called oversubscription. What do you do with all that extra cash?
Well, the company has two main choices. For the unlucky folks who didn't get any shares at all, it's simple. Their money gets refunded. But for those who did get shares, the company can just hang on to that extra cash and use it as a credit towards the next payment they owe. Pretty clever, right?
So the shares have been officially assigned, but the company probably hasn't collected the full price just yet. And that brings us to the final step in collecting the money, the calls.
A call is pretty much exactly what it sounds like. The company is calling on its new shareholders to pay up the rest of the money they owe on those shares. This could happen all at once in a final call, or maybe even in a couple of smaller installments.
By now, you're probably seen the pattern in the accounting. First, the company records that the money is officially due. So, a share call account is debited, showing that shareholders now owe this amount. And once again, the all-important share capital account gets a credit, bringing that ownership value even closer to its final total.
And for the final move, the cash comes in.
The bank account is debited one last time, and the share call account is credited to clear that debt. And with this final payment, the whole process is complete.
And there we have it. With that final chunk of cash in the bank, the cycle is complete. The shares are now officially considered fully paid up. The shareholder has done their part, and the company has successfully received the full face value for every share it issued.
So, we've walked through all the individual journal entries and steps. Now let's just take a quick step back and look at the big picture. What was the final result of all this?
When all is said and done, it really boils down to two simple things. On one side, the company's bank account has gone up by the total amount of cash it received through the application, the allotment, and the calls. And on the other side, its share capital account has gone up by the total face value of all the shares it issued. Simple as that.
So let's just do a quick recap of the key points. First, at par just means selling shares at their printed price tag or face value. Second, the whole thing is a three-act story: application, allotment, and calls. We saw how each of those stages has its own journal entries to track the money, and we learned how companies handle that good problem of getting too much application money.
So we've totally nailed down the process for issuing shares at their face value. But that brings up a really interesting question, doesn't it? What if a company is so popular, so in demand, that people are willing to pay a premium for its shares, to pay more than the face value just to get a piece of the action? Well, that's a whole different story, and a great one for another explainer.